But what I want to do here is take a couple minutes, spend a little time, because I think it's really important for you to understand the history of inflation and to go back to understanding what happens in these inflationary environments and what you can ultimately do. And I'm a big believer, history has a habit of repeating itself. Now, the environment's a little different today, and so there's a chance that some things would be different. But with 8.5% inflation right now, I think a lot of people are freaking out a little bit. When you look at history and you realize, what did we do in the past environments where we were in a very similar situation? I think you'll realize that this is going to actually open up a lot of opportunity in the short term. Not to say that there's not going to be some pain at some point in time, but I think inflation is here to stay for a little while, and I'm going to show you why. And ultimately, I think we're going to have to deal with it. But I think the answers will come out of this video, or at least you'll have a lot more clarity. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, we're going to be talking about inflation. Are we repeating history right now? Because I know what's going on right now in the world seems like a little bit overwhelming and kind of scary for people. When inflation is hitting this level of 8.5% for the first time in 40 years, a lot of people don't really know what to do with that information. We've never experienced it. I mean, I'm 42 years old myself. In July, I guess I'll be 42. And so it's funny to see that I've lived through a full cycle now, right? I've lived through this environment where we lived in this declining interest rate environment. But what I want to do here is take a couple minutes, spend a little time, because I think it's really important for you to understand the history of inflation and to go back to understanding what happens in these inflationary environments and what you can ultimately do. And I'm a big believer, history has a habit of repeating itself. Now, the environment's a little different today, and so there's a chance that some things would be different. But with 8.5% inflation right now, I think a lot of people are freaking out a little bit. When you look at history and you realize, what did we do in the past environments where we were in a very similar situation? I think you'll realize that this is going to actually open up a lot of opportunity in the short term. Not to say that there's not going to be some pain at some point in time, but I think inflation is here to stay for a little while, and I'm going to show you why. And ultimately, I think we're going to have to deal with it. But I think the answers will come out of this video, or at least you'll have a lot more clarity. So I really encourage, if you haven't already, make sure you subscribe, hit the bell, that way you get notified, because I'm going to be doing a lot of content on this as we go through. I think understanding how inflation works, how inflation and monetary policy and our national debt and all these things play into what we're doing here moving forward, understanding all that stuff is going to have probably the greatest impact on your success when it comes to your personal finances. It's going to have a greater impact than anything else in your life. And so that's why I'm doing these videos, to hopefully educate you on understanding what you can do about it. Now, what I want to do here is do a little bit of a history recap, because right now, listen, we're 8.5% inflation. I think it's probably going to get worse. But that said, the question is, what are we going to do about it? So I think, like I said, history having a habit of repeating itself. I think one of the easiest things to do is to take a look at history. So this is a breakdown of inflation in the past. Now, you could see here, this is year by year. I can go all the way back to the 1914, and you could see there was massive inflation from 1917 to 1920, and then there was a big deflationary year, right? So this isn't the first time that this stuff has happened. Then the Great Depression, you could see this is big time deflation, right? The negative years are negative years are deflation in real terms, right? So you can see here, let's go back to 1973 and 1974. This is, I think, the most real comparative example from what we're dealing with right now, right? And so this was obviously 45 to 50 years ago, almost 50 years ago, that we're dealing with here. And this is where inflation got real. 1973, inflation was at 6.2%. The next year it got to 11%. They reined it in. They slowed it down for a couple of years. But these are still numbers that are far above, and they far outdo the 2% target rate of inflation that the Federal Reserve has. Now, I'm a big believer that 1971, this is where we left the gold standard. And I think this is a big reason that this happened. Now, obviously, back then we didn't have the same national debt. We didn't have the same unfunded liabilities. We didn't have the same social infrastructure as far as taking care of people. These are all things that need to be taken into consideration. But what we do have is the inflation. And when we look at this, inflation at these rates really are crazy. So like if I go to 73 to 1981, you can see the average rate of inflation from 1973 to 1981 was 9.03%. That rate is higher than the rate that we're dealing with right now. And that was a sustained period of about 9 years, eight years or so. And so in that situation, this is just showing it's not unprecedented that we're going to have a long-term rate of inflation. Now, why do I think this is possible? Because if you go back through history now and you look for the last decade after coming out of this Great Recession, right? When you look at this, we've had 1.97% inflation during that period of time. I think that's unrealistic, and that includes 4.7% in last year. Let's go back there without the 4.7 year, and you're looking at about 1.54% inflation. So what that shows is we've been below inflationary expectations, even though we've been printing money, even though we've used quantitative easing, even though the Federal Reserve has been buying mortgage-backed securities and doing all these things and keeping interest rates low. It just hasn't made any sense. And so I'm a big believer that we've been manipulating the market. And I think what's really important to understand is these inflationary environments, they lead to circumstances from an economic position that we need to understand. And what I want to do here is I'm actually going to share, I'm going to share my whiteboard here. And what I want to do is I actually want to kind of break this down for you because I think it's really important to understand. So when you look at this whiteboard, what I want to do is I'm going to actually change the color here so we can deal with this. So you can see here, inflation. I'm going to do inflation in this. Actually, let me change the color. I'm going to do inflation in red because inflation is not good. So we'll just use red as a bad color. Now, inflation in 1976 was 5.8%. So let's just say 5.8%. Let's just say 5.8% is right here, 5.8%. So inflation was there. Then inflation ticked up all the way 1979 to all the way up to let's say 11%, 13% in 1980 right here. So it was 13.5% in 1980. So at that point in time, I don't know if you know this or not, but now I'm going to go to the federal funds rate. This is all really, really important stuff to understand. So in 1979, in December, Paul Volcker raised the federal funds rate. It was 6% was the federal funds rate. So I'm going to just say federal funds rate in 1979 was here, and he jacked it up to 19% virtually overnight. Now, why did he do that? Because he knew that if we had a prolonged inflation environment for, several years, like I said, the 8 years there were average 9.03%. So what did we have to do? We had to put ourselves in a position where we were getting that money out of circulation. We had to implement better, more sound economic policy. And so what that looks like is we have to put ourselves in a position where when we raise the federal funds rate above what the inflation rate is, that's what pulls money out of circulation. That's what cools the economy down. And you can see what happened thereafter when you look at the computer screen here is in 1980, we still had inflation. That's when he raised the federal funds rate. 1981, inflation went down. You can see it ticked down to 10% in 1981. We'll just say there. And then in 1982 and 83, it dropped down to 6 and 3%, right? So now it dropped down to 6 and then 3. And then it basically kind of hovered, for the 80s right down there. That's inflation was down in the, well, let me just run the numbers here. If we look from 1983 to 1989, you averaged about 3.64%. So after we went through this high inflationary environment, it still pulled back, and we're still in higher territory than the Fed target is really looking to be. But the bottom line is, from 1981 to, let's just call it 1989, I'm just going to 1989 here, right? Then inflation was under control. But here's the thing. Inflation was out of control, but guess what interest rates stayed at? And this is why I always tell people it's so important to understand. Interest rates were higher. So what happened is, and this is the component of this that people are missing, is that if you position yourself right now with inflation, with everything that's going on, to prepare and be ready for when this correction happens, that's where the opportunity is going to be created for you. Because right now, we are in this, like, let's just call it right now in 2022, it's the equivalent of 1974. Let's just call it that. And so I don't know if we're going to have 6 or 7 or 8 years of a run up before we run into this. The bottom line right now is I think we can't raise interest rates to control inflation. So I think we're going to have a longer period of time where interest rates are going to get out of control. So what does that mean? That means you got to put money into hard assets that are inflation hedged. That's one of the reasons I wrote my book. If you haven't read my book, Cash Flow Hacking, go get your free copy in the description below. It'll teach you how to leverage real estate to be able to create wealth, turnkey real estate, and the financial system that you can utilize to enhance cash flow real estate to reach financial freedom in a decade. And I'm telling you right now, it takes all of these variables into equation when you're talking about inflation, when you're talking about needing cash flow, when you're talking about the fact that we are going to have these boom and bust cycles. It all comes into play. And so when you look at this, this is why I'm saying to people, we've been living in this negatively performing or a decreasing interest rate environment from, and I'm going to go back to here. So this blue line here is the interest rate environment. So from 1980 to 2020, we basically got down here to 2009, we'll just call it, and interest rates have been flat ever since, right? That's where they hit zero, and since that, we've actually had quantitative easing, money printing, all these different programs that have been used to stimulate the economy. And now where we are is we are in an inverse, I guess, where we are living and experiencing the inverse from what almost everybody who has had a working, living, productive career has had. Because if we look at everybody having about a 40-year career, 1980 to now, people are retiring. Anybody who is investing and retiring and following any financial strategy from 1980 to today has been doing so in a decreasing interest rate environment. And now we're going to be in a flat or increasing interest rate environment. We are going back into the 70s where interest rates are going to have to go up to control inflation. And it's not a matter of if, it's a matter of when this happens. I think it could happen in a perfect world. So this is the thing. In a perfect world, this all gets controlled in a very short window, in a very short period of time. Like the Federal Reserve would raise rates and we would rein inflation under control, and they'd do it proactively. The problem is we're $30 trillion in debt as a nation, and for them to do what they need to do on the inflation or on the interest rate perspective, we'd default on our debt as a nation, and that would cause all sorts of other problems. And so the government isn't keeping interest rates low to keep the housing market going. It's not keeping them low to keep the stock market going. It's keeping interest rates low because of self-preservation, because they know that if interest rates go up, we are going to default on our debt, and it's going to be really, really ugly. And so what we need to be looking at here is realizing if that is the case, and we have to understand why these decisions are being made behind the scenes. If we know that the Federal Reserve is not going to raise rates simply because of that fact, I don't know about you, obviously there's no guarantees, but I'm going to put my money on the government coming at this from a self-preservation perspective and not wanting to implode, and realizing that what they need to do for the health of our economy long-term is ultimately not in the best interest of the country and our nation and our government. And so those are two opposing forces that ultimately we've never seen this environment before. That's what I was saying at the beginning of this. We have different environments right now that we're dealing with than we had in the 70s, but the principles of money, don't change. The principles of Keynesian economics and our elastic currency and how the Federal Reserve System and the fractional reserve banking system are supposed to function, that doesn't change. And so what I encourage you to do is think about, what does this window look like? It could be a year where they finally say, okay, we're going to do what's right. But I don't think that's going to happen. I think we're going to be in a situation now where the next 5 to 8 years, maybe decade, we're going to live in an inflationary decade. And what that looks like is the cost of goods are going to go up. Wages are going to have to increase. We're going to have to figure that out, because if wages don't increase with inflation, we're going to have what we call stagflation, which is going to put a lot of stress on a lot of people. It's going to create a lot of problems and ultimately create an inflationary recession or depression. And this is so vital to understand. And if you don't have your assets positioned properly, you are going to suffer through this. So my encouragement to everybody is to realize, when we look at this whiteboard, to realize that what you're doing now, we have to think long term. We can't think about what's the best thing to do today. We have to think about what's the best thing to do today and throughout the next decade. How are you positioning yourself to thrive in this new environment? And if you are buying and holding and putting money into a 401k or a Roth IRA or any of that stuff where you're giving up control of your money, I promise you that is going to be the place where people suffer the most. So I don't want to spend too much more time on this because I could go into like super big detail about this and get really granular. A lot of people's heads would explode, and I don't want to get too granular in that way, talking about numbers. A picture says 1,000 words. I think it's important to understand. And when we look at the board here, it's no question that interest rates have to go up. It's going to be very similar to 1979, 1980, where interest rates had to go up. It's going to raise the costs of borrowing. It's going to reduce asset prices. That's going to happen eventually. But I think what's going to happen in the meantime is we're going to have more inflation, and it's going to drive prices up. And so what you do to take advantage of that over the next 12 months, or I guess 1 year to 5, 6, 7, 8 years, is going to have a big impact. Now, that doesn't mean we're not going to have a market tick back 10 to 20% in the meantime. You can look at the Dow Jones in the 80s, in the 70s, and there were negative years. Even with inflation, there were negative years. And so it's a normal thing. We're going to have these pullbacks because costs of borrowing and asset prices, there's going to be these little fluctuations. But what's happening is we are at the end of a major, more significant cycle, because we have 8 to 12 year cycles, and we have 40-year cycles, we have 80-year cycles. There are bigger cycles where if you go and you do your research and you look through history, this stuff happens. And so we are at the end of this. And I think it's really important that we look back to the late 70s and early 80s. And that is the most recent and the most accurate piece of history that indicates most likely how we're going to respond to this and how the economy is going to react. And so anyway, any questions, any comments, leave them in the comment section below. If you haven't already, make sure you subscribe, click the bell, that way you get notified every time I launch a new video. I hope you found this valuable. I hope you take this and you implement it in your life. If you have any questions about it, anything, you can go down below, get on the phone. There's a link for a clarity call. You can have a conversation with one of our Life 180 coaches. They can help you out. It's totally complimentary. No pressure, no harm, no foul. Just want to serve people. Until next video, have a blessed, inspirational day, and we'll talk soon. See ya.